This year is going to be very notable. We're going to have a lot of active managers that underperform their index simply because they didn't have enough weighting in these small handful of stocks that have been driving the markets this year. So there's going to be a good bit of catch-up trade going into the end of the year to make sure they've got Apple and Meta and Nvidia and those stocks on their books going into for end of the year reporting so that they have that in place going into next year. So that's going to be that Santa Claus rally last week or so of December, first 2 days of January.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back at the end of another week for another weekly market recap featuring my good friend, the comeback kid, portfolio manager Lance Roberts.
Why am I the comeback kid?
Kind of several different reasons here. One, obviously, you were a fighter in your youth, and I'm sure that when you were down with
Yeah.
your grit and your determination, you'd fight your way back, just like the market has been doing, actually, from the swoon from last week or the
Yep.
week before. As from what you tell me, your wife's treatments are going well, so she's fighting the good fight here.
Right.
And we might talk about this near the end, but I'm finally back to making some progress in the gym, and that feels good too. So,
Nice.
yes.
Awesome. Congratulations.
Thank you. Lot of comeback themes here. We should let folks know first off, though, that we are recording this on Thursday. We're not recording on a Friday like we normally do. And that's because this is one of the weeks where your wife goes and gets her chemo treatments. And
Right.
usually we have Mike Leibowitz step in your absence, but he can't this week. So we just have to do it a day early.
You just have to suffer through another week with me. So
Well, folks, don't worry. You're almost at the holidays. You almost might get a break. So yeah, let's
exactly.
strap in.
No, no, actually, Mike Leibowitz is in Houston this week. So,
Are you seeing him or is he there for something else?
oh no, no, he's here for us. And tonight we have a kind of an event for some of our investors and things. So he's here for that. So we're having a dinner tonight. And but no, he's gonna be traveling back by air tomorrow. So normally when you're recording, he's gonna be in a flight back. So that's why he couldn't do it tomorrow.
Okay. Well, hey, speaking of events, I know we mentioned this briefly last week, but for those that didn't hear it, the RIA annual conference is going to be next month, right? January
Yep.
17th, I think, if I get the date right.
That is correct. January 17th. We've got a whole lineup of speakers. Of course, you'll be there along with myself and Michael Leibowitz. We also have a gentleman from BlackRock coming in, Brian Dunlap, that's going to talk about artificial intelligence, the future, where, kind of BlackRock sees the future of artificial intelligence. Of course, they're right in the middle of it all with, all the funding and things that are going on. They're big players in the private equity
I got
space
a
on
lot
the
of
outside.
questions for him, so I'm really
Yeah,
looking
yeah.
forward to that one. Some probing, but also just I'm looking forward to listening too.
Exactly. And then we also have a very interesting young Of course, everybody's kids to me these days.
I know.
Just everybody's so young, but very interesting young gentleman, Daniel Kang, who's the chief strategy officer for DeFi Development Corp. And they are a stablecoin issuer. And they're doing a lot of work with Solana. They're going to be here talking about Bitcoin, cryptocurrency, stable coins, all that type of thing. So and then we have Ed Slott, who's America's financial planner. He'll be here talking about Social Security, Medicare, financial planning. It's going to be a really good conference this year, so I'm really excited about it.
Should be great. And is there, so that's the 17th, I
Yeah.
think is a Saturday.
Yep.
Is there something the night before, like a mixer
Yep.
for VIPs? Am I remembering that correctly too?
Exactly. Yeah, we've got two tickets that are for sale right now, and actually we've got the sales are going really well. We're going to sell out pretty quickly this year. So if you're interested in coming, be sure and get by the website, realinvestmentadvice.com. There's a banner right at the top of the page and here I'll just show you real quick. There's a banner right at the top of the page that says 2026 RA Economic Summit. Register now. If you click that, that takes you to this page, which is basically a link over to Eventbrite, and you can buy your tickets. And there's a ticket for the actual conference. And then there's a ticket for the night before where we're having a mixer, and that's a limited set of tickets we've got. But that you'll be there, I'll be there, Mike will be there, all the speakers will be there, so you'll be able to kind of just mix, mingle, ask questions, and just kind of have conversations with all the different speakers will be there. So that'll be a lot of fun. We do have a block of rooms set aside for people traveling in from out of town. So if you are interested in coming, go buy your ticket and then send me an email and say I'm interested in a room, and I'll get you connected with Michelle Ratliff in my office who can get you taken care of.
All right, great. And this looks like it's the Royal Sonesta. That's where we did
Yeah,
this last time, right?
that's where we were last time, correct?
Okay, great. So we got Ed Slott there. You said he was America's financial advisor. Um,
America's financial planner. He's one of the
America's financial
leading
planner.
minds in financial planning and Social Security and Medicare and all that.
All right.
He's basically Richard Rosso's idol. So
Oh, really? Okay. So I was going to say we have America's financial planner, and then we have America's portfolio manager with you there. So
exactly. So
it's a
it's going to be a
meeting
lot
of
of fun. We're
it's a
really
meeting of
excited.
titans. Okay, great. Well, folks, hope to see you there. All right. Well, let's get to the markets here, Lance.
Yes, sir.
So, continuing our comeback kid theme, folks were beginning to wonder if, a knockout blow had been dealt to the markets because we had that failed rally initially with Nvidia after they gave their blowout reports, and there was some questioning of, hey, could this be it? Could this be the top in real time here? Was that just the popping of the AI bubble? Um, as you said, probably far too premature to make a statement like that, and markets did stabilize, and they're not back to all-time highs, but they're darn close. I think you even just wrote a piece today that said, yeah, we might have a little bit of volatility here in the very near term, but things still look pretty decent for a
Mhm.
year-end rally, a Santa Claus rally into the end of the year. You still feeling the same way?
Yeah, yeah. And here, we can jump some technicals real quick and just talk about what's kind of going on technically, because it all kind of feeds into this. So first of all, it's always interesting to me, Adam, that whenever the market has a little bit of a pullback, everybody immediately, and again, this is human nature, right? If like it's like the old Rorschach's test where you get an ink blot and then they say, what does this look like? And everybody comes up with what it looks like because that's the human brain, the way it works. If there's a lot of randomness that's going on in anything, the brain tries to organize it. Same thing in the market. So, when markets are going up, everybody's happy, right? It's just markets are going up. I throw money in the markets. Everything's great. I just keep making money. But when you start having a bit of a correction, immediately we have to, as humans, start to rationalize why this is occurring. And so it's the death of the AI trade, or it's this, or it's that, or whatever else it is. And we've had a lot of these narratives over the years. The dollar debasement trade. We've had the inflation concerns. We've had this. We've had that. And markets have just kind of worked through all of this. Regardless of all the narratives, the markets have continued to kind of progress forward. And so, it's important to keep things. And my point about this is that as investors, we need to step back and put the narratives aside and just look at what's actually going on in the markets. And when you look at the market, we had an exceptionally strong run in the markets from the April lows. So markets have gotten very overbought. You had a very big advance from those April lows. We were up like 35% from the lows. So just very, very strong. So a bit of a correction or consolidation would not be surprising at all. And we started that consolidation process actually back in October, mid-October. We had that day, that Friday, where the market was down 2.7%. And that was really kind of the beginning of this consolidation period we're in. Yeah, markets went to all-time highs right after that. Then we corrected back down, retested that low, and then we've rallied back up close, but now back to all-time highs. So really the market hasn't gone anywhere over the last month or so. But what we did do was we worked off a lot of that overbought condition. We reverted markets back towards their means. So we got back to the 50 and 100-day moving average, which happens on a normal basis. And then we've rallied nicely off that. So, this is all playing out closely to seasonal tendencies. The seasonal tendency for any given year is typically some weakness at the beginning of November, a rally at the end of November, because that's basically when professional traders go away. It's a Thanksgiving holiday, inmates are in the asylum, so markets tend to trade better. First 2 weeks of December, so you had this rally, right? We had the rally that normally happens at the end of November. Now, the first 2 weeks of December, you typically get some sloppiness. And I think we talked about this last week, you have mutual funds making their annual distributions of capital gains, interest, and dividends. So you're going to get a little bit of selling pressure for the next week or so. And a lot of those distributions are going to occur next week. So when that occurs, this market's likely to pull back. We probably get a pullback maybe to the 50-day moving average, maybe a little bit below it. Maybe we retest the 100-day moving average again, certainly possible. But then that will set you up for the year-end rally because now the portfolio managers need to make sure they've got all the right stocks on their books for the end of the year in the right weighting. So there's a lot of professional managers this year. Every year we have these reports that say, 80% of active managers underperformed their index last year. This year is going to be very notable. We're going to have a lot of active managers that underperform their index simply because they didn't have enough weighting in these small handful of stocks that have been driving the markets this year. So there's going to be a good bit of catch-up trade going into the end of the year to make sure they've got Apple and Meta and Nvidia and those stocks on their books going into for end of the year reporting so that they have that in place going into next year. So that's going to be that Santa Claus rally last week or so of December, first 2 days of January.
Okay, so that's still your default.
Well, that's just no, that's just statisticals, right? That's just
Yeah.
statistical. And if you go back and look at every year, that's how markets average on kind of average on a basis. Now, a couple of things about that. Does that mean that every year, every December is positive? No, absolutely not. But one thing that happens very rarely, and it's a very rare occurrence, is to have two negative Decembers in a row. And last year was a negative December. So we could have a negative December this year, but that would be a very rare occurrence if that occurs, statistically speaking.
Yep.
So my outlook for this year is really nothing more than really just a combination of three things. One, earnings were very, very good for the third quarter. Outlooks were good. Outlooks raised guidance across the board. So the corporate earnings outlook right now for stocks is very good. Secondly, corporate buybacks are running at about $5 to $6 billion a day. That's buying pressure. You got retail investors that have stepped in to buy the dip recently. We haven't broken that retail kind of buy the dip analysis or mentality at this point. And then, like I said, the other big driver is going to be positioning for a year end. So there's some, and actually, this is funny you asked the question because this weekend's newsletter is basically the bull case, bear case going into 2026. And so there's going to be some things that occur next year that I think are going to be important. But I think the setup right now, statistically speaking, is in the favor of being more bullish than bearish.
Okay, sorry. That's interesting. So real quick, I think your default assumption or your default positioning is that this is more likely than not going to be a regular type of December because you're not seeing anything that is saying, I think it's going to be negative and therefore we're positioning for that. I think
Right.
you're not, right?
Right.
And I was just about to get to that question, but you beat me to it. So I believe from our most recent series of conversations, Lance, you've said, hey, I'm actually pretty concerned about 2026.
Mhm.
But it sounds like having just written this latest article, maybe you're not quite as concerned as you were. Is that what I'm hearing?
No. I am concerned about 2026, and let me rephrase that.
Okay.
Because I don't want people to go, Lance thinks the market's going to crash next year. No, I'm not saying that at all.
No, I know. And just so you know, I'm about to connect what you say to what Jim Carson just said on this program. So
Okay.
say your
That's fine.
thing and
Yeah.
then I'll
So
connect it.
I think so. And let's rewind the tape. January 2025. I said expect a year of higher volatility and lower returns. Well, we definitely had higher volatility this year. 20%. We've had two 5% drawdowns and a 20% drawdown in the middle. So we've certainly had higher volatility, but returns have been very, very good this year.
Right. And that's
So,
a third year in a row, which is rare.
which and also is one of the things that statistically speaking, moving into next year, whenever you have a 36-month advance that's two standard deviations above kind of the 3-year moving average, that usually leads to lower forward returns. Now, that doesn't mean the market crashes, right? I'm not saying don't walk away from this conversation and go, I'm selling everything. Like I said, the market's going to crash. No, but I would, and again, kind of a lot of things are lining up now in terms of if you look at like some of the recent employment data, ADP report this last week was negative. I think we're going to see slower employment growth as we go into next year. ISM manufacturing is still in contraction. ISM services is barely in expansion. It's been that way for a very long period of time. And that's in and of itself very unusual, but kind of shows you that the economy's just kind of really returning back to that 2% growth rate. So it's just chugging along. It's not really advancing to any great degree. And then if you look at leading indicators versus coincident economic indicators, that ratio between the LEI and the CEI is at a level that's normally suggests much weaker economic growth. Now that will all feed into earnings. So next year, again, with the statistical norms of the 20% return years for basically 3 years in a row, that's very abnormal. So you're getting a reversion back to the mean in these returns. So you get back to maybe 6, 8, 9% returns next year, including dividends, and that's going to feel crappy. It's like, what a crappy year. I only made 8% this year.
Right, right.
But again, it's you're going to get that type of reversion. Could you have a negative year next year? Absolutely. That's certainly possible. But I think you need some type of event that goes along with that.
Yeah. Okay. So, again, just to make sure I'm understanding your point of
Mhm.
view, you have concerns going into 2026. You're not ringing the five-alarm fire bell by any
Right.
stretch, but you're saying, hey, look, for a whole bunch of reasons you just mentioned, it could be a disappointing year for investors. And disappointment it's a wide spectrum, right? It could be a
Yep.
down year, and that's very disappointing, right? But it could be a single-digit return year, which when you've
Yep.
gotten spoiled, like if you were a Chicago Bulls fan and after their third title you were expecting a fourth, right? Like okay,
Yep.
you're going to be disappointed. Um, I just want to note that had a really interesting conversation with Jim Carson. Um, for folks who know him, he's a real volatility specialist. He's a big statistician, and he does look through the similar lenses as you, Lance, about earnings and all that type of stuff. But he also uh, studies probability and risks and historical cycles,
Mhm.
and he thinks basically that the bottom line is that he thinks volatility is going to continue to build going into 2026. And at a very high level, and I don't want to spend too much time on this, he thinks we have gone through like a secular shift in the markets, and it's largely you know, almost like the 40-year bond bull market, at the end of that and going into a different era. And his words, not mine. He sees a pretty high danger of like a lost decade ahead.
Mhm.
Not too dissimilar to the way that, say, like a John Hussman does as well, when you look at
Right.
average returns when valuations have gotten where they are here, right?
Yep.
Uh, and he's basically saying, look, active management's going to be your friend in this environment, right? Because the market on average may go nowhere over the next decade, but there's going to be lots of ups and downs. And so obviously,
Mhm.
if you like to play volatility, if you're like you, Lance, you're focused on trying to maximize your share of the upside and minimize your share of the downside, you can
Mhm.
actually do pretty well. But if you just use the standard passive buy, hold, and forget it, that's likely not going to work very well going forward. So that's his
Mhm.
long stretch. In the short term, he thinks that the market is in a what he calls a topping process. And
Mhm.
he says hard to call those things when they're going to end. Certainly hard to call to the day of the week or the month. Sometimes hard to call in the quarter. Sometimes even hard to call in the year. But he believes that the market is in a topping process right now. And kind of the biggest question in his mind that he doesn't know, but he's looking on how to play either sides is, does this end in a blow off top, like bull rallies tend to, right? They're
Mhm.
what one last blaze of glory,
Yep.
and then correct, or
Yep.
does it just top and just kind of grind downwards, from there?
Yep.
And so he's looking at both, but he basically is saying, look, I think 2026 is going to be a more volatile and a more disappointing year for investors. And who knows? I'm just saying
No.
it's another outlook that's not dissimilar from yours, and he's
Yeah.
bringing in some similar data, but also some different
Yeah.
approaches as well.
But no, no, valuations, the problem with valuations is always the timing issue
Right.
of them, right? Valuations are great for telling you what forward returns are going to be over the next 10 to 20 years. And right now, where valuations are, those returns are going to be low single digits after inflation, right? 1, 2% type things. That's what normally you would expect. That doesn't mean every year is going to be 1 or 2%. It's going to mean you're going to have a 20% down year somewhere along the way, 20% up year, another 10% down year, that type of thing. And you kind of wind up towards 1 or 2% at the end of a decade. But that's what valuations tell us. And I agree with Jim is that, the problem going to next year is that valuations in the short term are simply just sentiment. And in the short term, valuations are high because everybody's willing to overpay for stuff. But that eventually has a negative outcome.
That's the voting machine. It's not
Yeah,
the way
that's the
the
voting
voting
machine.
machine right now, not a weighing machine. Yeah.
Exactly. So no, I absolutely agree with him. And I've written some articles recently talking about the importance of valuations. I think about an article coming out next Friday, actually, on valuations and forward returns. And they're very important to consider. But where investors go wrong and is that they hear a conversation like this and they go, "Oh, valuations are high, so I'm getting out of the
Right. So
market."
they run to safety too much.
Yeah,
Yeah.
yeah. And it's a terrible timing. So valuations are the worst kind of technical indicator. You
Indicator.
never use them for that. But they are important to pay attention to. And again, when you overpay for something, whether it's a stock or anything else, you're going to wind up with lower returns in the future. Just like if you overpay for a house, when you go to sell it later, you're not going to get as much for it.
Right, right. So let me pull way back here for a second.
Okay.
Well, before I do, two things. Uh, Going forward into this new era, from Jem's perspective, he says, look, risk management is going to become even more
Mhm.
important, and I'm underscoring that because I believe you feel the
Yep,
same, Lance. Okay.
absolutely.
So, all right, zooming way out for a second, just based on what you said about valuations, right? Um, we don't know what's going to happen in the near term. Anybody's game, timing's hard to tell, but we can have a lot of confidence in the longer term, say next 10 years, that returns will be disappointing relative to how they've been for the past decade or two,
Yep.
right? All
Yep.
right, so we got a lot of people who are watching this video right now who are retired or close to retirement age, right?
Mhm.
Um, to me, that's a really key switch to flip in their minds if it hasn't switched yet. I'm guessing most of my viewers, the switch has already flipped. But it's like, look, if you are depending upon your investments to bring you a return, you know, now that you're stopping working or now that you're no longer working, you got to say, okay, what am I going to do? What's my strategy if the next 10 plus years are likely to deliver disappointing returns, right? And I maybe just making a case for you and your business, Lance, but I mean, to me, that says you really got to think about being more active than using the passive playbook,
Yeah.
which admittedly has worked great the past 20 years. With a couple of brief punctuated, brief downturns, the passive investing, set it, forget it, buy the dip has worked great. But if you use that playbook going forward from here, you very well may be sort of sleepwalking into disappointment, maybe even danger.
Yeah.
So just at a high level, what's your reaction to that? Because I do think, I mean, again, my viewers kind of already get this stuff, but I think the vast majority of people who are at retirement age and looking forward to living off
Mhm.
their investments going forward, who are not thinking this way, are really at risk of getting seriously compromised.
Yeah. And so I'm showing you a chart right now. This article is a little bit dated. I wrote this article October of last year, 2024. So it's a little bit dated, but the data is still all correct. And and when you start talking about, again, what you're talking about is that, and the data is very clear going back historically to 1900, that again, high valuations lead to lower forward returns. And this is the important thing though to understand. This chart right here, I think, is the most important thing that everybody needs to pay attention to. So if you look at this, is looking at the average annual total real return. So this is after inflation, including dividends in the markets over different periods of time. So from 1928 to 1923. Now, again, this data ends in 2023 because this was written in October of 24. Okay, so just there's 1 year's of data that's in. It doesn't change the percentages much, but so with that in mind. But the average rate of return from 1928 to 2023 was 8.45%. That includes dividends, that's after inflation. The economy grew at 6%. The average dividend yield was 4%. And basically, your inflation rate was running at 2%. So, you do the math, growth 6%, 4% on dividends. That's the 10% you always hear from people, right? Market returns 10% a year. That's 6% growth and 4% dividends.
Dividends.
Subtract that
Yep.
inflation, 2%, you get 8% ish, right? So that's what you would expect out of a normal market. And that data holds true from 1928 to 1999, 1973 to 2023. No matter how you slice and dice that pie, it all runs right around that 8%-ish goal. And that's what markets should return over time in an environment where the economic growth rate is 6%. You have dividends of roughly 4% and inflation running at 2%. We don't have that anymore. We haven't had that since the turn of the century. Economies, and since the financial crisis, we're growing at 2%. Dividend yields are 2%. Inflation is 2%. So technically, you're talking about 4% rates of return is what you should be getting. But no, we've been getting 50% more in returns since the financial crisis. We've been generating 12% annualized rates of return instead of 8. And that's because of zero interest rate policies, monetary accommodations, quantitative easing, HAMP, HARP, TARP, every type of bailout you can imagine after the financial crisis, the bailouts, the from following the pandemic. We've completely morphed the markets into generating rates of return that are higher and exceptionally, and again, mind you, exceptionally higher than what the actual economy is generating. And so the return to normality, this is the thing that most people need to be aware of going forward. If you're, and I'm seeing a lot, I'm getting a lot of people coming into my office and they're saying, oh yeah, we're if we can just generate 12% rates of return in retirement, we're good. That's what they're used to over the last 10 years. And you
Yeah.
listen to the media. The media says, "Oh, if you're a young investor, let's just talk about something real quick, right?" So just had this whole announcement from the Trump administration about these $1,000 accounts for people under the age of 10, and
Yeah.
it's going to be in an account, and that's going to grow into a big nest egg for them. Well, they assume in these type of things, you hear this on CNBC all the time. It's like, well, if you're just a young investor, if you'll just put $500 into a Roth IRA and you grow that at 10% a year over the next, 40 years, you'll have $1 million in the bank. Okay, well, the fact that $1 million 50 years from now isn't $1 million today because of inflation is a different story. But we're assuming these exceptionally high compound rates of growth, and the market doesn't compound. Markets do not compound returns over time. If you have a year of loss, it completely destroys the compounding effect. But we assume that markets are just going to grow at 10% a year, and they don't. So when you have these exceptionally high rates of return, when you get a return to normality and we start generating what we should be, which should be 4 to 6% rates of return, given current economic growth, the debt, the deficit, the demographics, those type of weights that are on the economy, you're talking about 6 to 8% rates of return, maybe in a good environment with low inflation and higher economic growth. But if we just generate 2% growth, 2% dividends, and 2% inflation, you're going to be cranking out 4 to 5% a year. That's a very different return factor for investors than what they've had over the last 15 years.
All right. So, yeah, I imagine you would say, look, if you are approaching retirement or in retirement, you better have revisited your financial plan at some point recently, right? So
Yeah.
what are your assumptions going out there? And if you're using assumptions that are based off of those sort of, recent historically aberrant return rates, you're probably setting yourself up for disappointment going forward. So you better put some more realistic assumptions in there. And particularly if you're still working and approaching retirement age, you might say, "Gosh, you know what? Maybe I got to work another 2 or 3 years and sock away more. So I'm starting from a higher base so that I can make it on 4 to 6%, right?
Yeah.
Rather than just crossing your fingers and just hoping that past will be prologue, which you've said valuations in the long run pretty good about nailing what's going to happen with returns."
Yeah. Yeah, and look, at the end of the day, as individuals, right? I think this is the most critical mistake that, and look, there's a lot of conversation, about the wealth gap and this gap between the top 20% and the bottom 80%,
And we're going to get there today, just by the way.
okay, and young people can't afford anything today, and yes, we can certainly make a lot of those cases, but at the end of the day, the responsibility is on us, right, as individuals. And I work with a lot of individuals, thousands of individuals I've worked with over the years that have grown their way from nothing into something
Right.
because they did all the right things, right? They saved money, they budgeted, they lived on less than they make, they saved, they invested prudently. and they built a big nest egg for their retirement. And that is not out of the reach of anyone. Everyone can do that. But what's important when you're thinking about that is not saying, I'm going to depend on the market to make me rich. So I'm going to gamble in the markets and I'm going to take on a bunch of leverage and a bunch of risk to get rich quick instead of doing the hard work, which is the boring part, which is just saving money, right? And
Right.
allowing the markets to help make sure that the purchasing power of those savings remains the same in the future and that you have an inflation adjusted savings rate over time. So the value of that dollar today is the same value of dollar purchases 10 years from now, 15 years from now, 20 years from now. So that's, and again, it's a big blow to a lot of young investors today because the SEC has denied all the ETF manufacturers 5-time leveraged ETFs. They said cannot do it.
Mhm.
So if you were betting on 5 times leverage Bitcoin to get you rich, that's not going to be made available because there's an SEC rule you can't have more than 200% leverage, on an ETF. So
Right.
big
Well,
big blow to the speculative crowd today.
yeah, big blow, but that probably I'm not a huge fan of the government, determining what's safe and
It's probably a good thing.
but to me, yeah, exactly. Like, safety rails on a mountain pass, a narrow mountain pass, that actually makes a little bit of sense.
It does.
Preventing 5x leverage ETFs, probably about the same. All right, so a couple of things. So just to underscore what you said there, because I know we've talked about it in the past, but yes, in the prime objective of investing, we talk about earning, savings, and investing. The
Yep.
prime objective of investing is to maintain the purchasing power of what you have saved, right?
Right.
Um, Now, it doesn't mean that you can't have a secondary objective of, hey, let me actually grow that above the rate of inflation
Sure.
if I can prudently.
Right.
And there is potential to do that, but that's not a guarantee, right? So the thing to really focus on is, hey, let me make sure at least what I'm socking away is keeping its purchasing power, and then anything above that, gravy, right?
Exactly.
Yeah. Okay. So, well, there's something else I was going to say there, but whatever, out of my brain. We'll move on. But no, I'm glad we had this conversation though, because the eye I just wanted to open for folks is, you know, we may be going into a lost decade and a regime change the way that Jam thinks. But even if we aren't, just a steady Eddie guy like Lance is just saying, hey, just from valuations alone, we know that we mathematically, we have a very low probability mathematically of enjoying the returns that we've enjoyed over the past 10 years going forward for the next 10 years on
Yeah.
average.
And just to conclude all of this, then we'll move on to the next topic is look, these when you hear things like from Jim or John Hussman or me talking about forward valuations, return profiles, those are things that you put over in this category of, hey, this is important, but it's not going to affect my portfolio decisions today, right? I'm just going to keep my eye on this. I want to be aware of this. It's in a box over here that I can see and I can measure and I can pay attention to. But don't take that and then go adjust your portfolio investment strategy today because over the course of the next 3 months, 6 months, 9 months, 10 months, 12 months, the markets can do things that make no logical sense whatsoever. They can, and again, like Jim said, we could have a blow off top, we could have a smooth kind of
Right.
rounding topping process.
Well, we could still have a lost decade, but the
Sure.
next 4 years could be blockbuster years, right?
Absolutely.
Yeah.
And so the goal, my only point is it's important to be aware of these things, but we can only manage our portfolios for the next month, the next 2 months, the next 3 months. That's basically our visibility of the markets. So, manage your portfolio for the risk that's in the markets today, but be aware of this over, kind of this thing over here and say, am I taking on too much risk? Am I using a lot of double leverage? Am I on margin? Maybe I should reduce some of that a little bit just because I'm really kind of extended over my skis. Maybe if I've got a lot of, I've got all my money in, high beta assets, Bitcoin and technology stocks and those type of things. Maybe we add some defensive stocks to the portfolio. I know they're boring, they pay dividends and stuff, but maybe add a little bit of that buffer to the portfolio just to protect you in case you hit a bout of volatility that you weren't anticipating. It allows you to survive it and navigate through it.
So totally agree. And again, I just want to underscore my point, which is
Yeah.
if you are making decisions about the next 10 years or more, like when to retire, this is really important to take this stuff into
Yep.
consideration, right? So
Absolutely.
yeah, you may need to, you may need to make the decision after doing the math to say, hey, I might need to actually either
Mhm.
work a few extra years, or if I'm 5 years away from retirement, when I want to retire, I've got to maybe put 20% more away a year than I
Yep.
was initially expecting, right? So anyways,
Yep.
think about it that way. If you need some help, talk to Lance and his team. They'll help you think through all this stuff.
Yep.
Okay, so still got a lot to churn through here. Um, I want to get to the jobs data. I want to get to what's going on with the Japanese bond market. But real quick, since we're talking about what could happen
Mhm.
with the markets, again, folks, we have no idea what's going to happen next year. Maybe it's a blockbuster year. Maybe it's a terrible year. Maybe it's just a boring year. Who knows at this point in time. But Lance, you just recently wrote a piece called "A Bear Market is a Good Thing," which
Yep.
I agree with you. In the long run, they're never fun to go through. So
Yep.
I don't want to paint it like, it's going to be, if the next one we go through is going to feel like sunshine and roses.
Yeah.
Yeah. But just as winter is an essential season, to the cycle of life, uh, to be able to enjoy the next bull market, you need to have a bear market that
Mhm.
cleanses out the malinvestment, gets valuations down to reasonable levels, all that type of stuff. So,
Yep.
what do you want to say about that piece you just wrote?
Well, no, it's that. I mean, and basically, I was feeding off an MIT study about California, actually, and I can talk about California now that you're not there anymore. Um, so,
You kind of slammed it a lot when I was there, but I was slamming it with you. It was well deserved.
well, they're good fodder. But no, but MIT did this study about California and their forest management, and MIT, what they noted was in their study is that California, did a lot of stuff where they weren't really doing good land management. They were, they were worried about the ecology or whatever it was, and they allowed a lot of the, kind of the debris to pile up in the forest, and it just created the fuel for a forest fire to occur. And when that forest fire occurred, it actually was a lot worse than it should have been because there wasn't good management of the forest ahead of time, and so it just made the outcomes worse. And so the kind of the point of the article is that that's what we've been doing over the last 15 years, is that we've been doing poor forest management. We've been doing everything we can to not have a recession. 2020 was a good example. We shut down the economy. We should have just allowed that process to work itself out. But instead of us doing that, we came in with 150 billion, 120 billion a month in QE. We were bailing out high yield bonds. We bailed out the banks. We bailed out companies. We were just doing all of the sending checks to households. And I get it. I understand the reasonings why. I'm not arguing that. But we've had these potentials. 2008, we should have allowed banks to go bankrupt that were heavily involved in the mortgage scam, right? It's just, hey, you were involved in this. I mean, these major banks, Bank of America and others. A lot of individuals aren't aware that the major banks were paying huge fines to the government under the Obama administration for not admitting or denying any wrongdoing relating to the mortgage crisis, but they were right in the middle of this. And again, we were, instead of allowing the process of corporate bankruptcies to work through that system, and yeah, maybe Goldman Sachs went out of business, that would be okay. There would be another, aka Goldman Sachs, that would have taken its place.
That
Same
was
thing
hopefully
with,
more prudently run. Yeah.
yeah, yeah. And JP Morgan might not be JP Morgan anymore. It might be a bunch of, mid-sized banks now after they got broken up. But the point is that the system, yes, the devastation, had we allowed that to occur, would have been terrible. The recession would have been worse. The economic impacts would have been worse. The financial impacts would have been worse. But we would have been healthier on the other side of it. Valuations would have got reset. We would have cleaned up a lot of the banking misdoings, et cetera. It's just like today. We suspended mark-to-market accounting to help the banks out during the financial crisis. We never reinstituted it. It's still We still don't account mark-to-market accounting for the bank. So,
Mhm.
those are the type of things that foster the type of environment. Of course, zero interest rates, everything else we've done, So we've done very poor forest management, and eventually we're going to have a bear market. And unfortunately, when we do have the next leg of the full market cycle, that's going to be potentially much worse than it should be because we didn't allow these opportunities 2020, 2015, 2012. When we had corrections in the market, we did things to stop those instead of letting them, go to their fruition and allow the market to be healthier. So, that's really the point of the article, is that ultimately we're going to have a bear market. That's actually going to be a good thing. And if you're adept enough to navigate the bear market when it comes, and I'm not saying this next year, I'm not saying it's the year after, it could be 5 years from now, but we will eventually have a bear market. And when it occurs, if you can successfully, navigate that bear market, the opportunities to make real money coming out of that are going to be fantastic.
Yeah, and I think that that's where a lot of people watching this channel will be very interested. One, because I just know from talking to them, on average, capital preservation is their number one priority. In other words, okay, how do I not become
Mhm.
collateral damage to that bear market, which will likely be more painful than it otherwise would have been had we been doing controlled burns, which we
Right.
haven't been. In fact, we've been pouring Miracle Grow, on all the brambles and all the weeds.
Exactly.
um, that become all the tinder. Um, but secondarily, the people who are being prudent, are hoping that, hey, not only can I hopefully avoid the worst of the downturn, but when there are much better valuations to be had, and if I was prudent enough to protect myself and build some dry powder, I wanted to deploy that at really attractive valuations and then ride the next upswing.
No, that's exactly the point. And again, the challenge for investors is going to be to not act too early. But again, if you're worried about these things, look at your portfolio. The best way to navigate whatever comes, again, just higher volatility and eventual bear market, whatever it is, do prudent things within your portfolio, reduce leverage, reduce exposure, reduce beta, those type of things. We've gotten very used to taking on excess risk and being rewarded for it, which makes us think we're a lot better investors than we actually are. But eventually that's going to bite you in the butt. And so, if you can live with lower rates of return, I don't mean, 1% returns, but instead of chasing 20% returns in the markets, learn to be happy with what's enough. There's about every year I write an article talking about understanding the value of what's enough. And it's like saying, Adam, you've done a great job this year. I'm going to give you a Mercedes. And so you're very happy. You just got a brand new Mercedes. But then you found out that I gave Brent in my office two Mercedes. So now you're upset because you only got one Mercedes. He got two, but isn't one Mercedes enough? I mean, can't you be happy with just a brand new Mercedes in your driveway? But this is the problem with the markets, is that we're always wanting what our neighbors have, what everybody else is saying they have. And a lot of it's crap. I mean, the stuff you see on social media, it's like, here I am with my private jet. Yeah, they rented that last hour, for them to take the photo op in front of the jet. That's not their jet. But we all want to portray that we're making all this money and it's all great, it's all fine, and maybe you are, that's fantastic. But it's also important to learn with, instead of chasing 20% return years, be happy with 10, be happy with 8, because it's well above the rate of return you need to grow your money into retirement. And you can do that with a lot less risk, because chasing those 20% returns are going to lead into really big losses at some point in the future. And that's where the real damage occurs.
Right, right. And we've talked about this, but
Yeah.
again, it's worth reiterating, which is, again, this is why financial planning is so important, is because what you want to find out through the financial planning process is how much you need, right?
Mhm.
You define what enough is for you, and you find out, okay, well, here's my starting point. This is what enough looks like to me. This is the time horizon I have, and this is my earning potential, and this is what I think the market will do, and all that stuff, right?
Yep.
And then you determine, well, okay, so what return do you need to get to enough? And for a lot of people, it's less than the average market return.
Yeah.
So you can get to enough by taking less risk. And as you've talked about the math in previous videos, for every like 1% additional gain that you're trying to shoot for,
Mhm.
the risk goes up dramatically.
Exponentially. Yeah.
Yeah. And to your point, it's like, why? Are you doing it because you need it to get to enough, or just because you see your neighbor driving a fancier car or going on a vacation that you're not. And to your point, a lot of that might be debt financed, right? Their car might
Yeah.
be a week away from getting repo. Like, a lot of it's fake anyways, right? So
Yeah.
the key thing is to know what enough is, come up with the most risk-adjusted plan to get there, and then just sleep at night and enjoy your life along the way. And in the
Yeah.
conversation with Jam, he talked about the same concept, and he talked about things like like he said, one of the best things you can do is diversification, which is kind of like a no duh, right? But he's like, most people don't really understand. Like, diversification means exposure to non-correlated assets.
Right.
So people will be like, well, look, I'm diversified. I've got this sector of stocks, I've got that sector of stocks. Yeah, okay, but they're all equities, right?
Yeah.
So, he one of his things is finding these asset classes that truly have, no statistical correlation, or close to no. But he also talks about, things like, it's like, you don't have to agree with this, but he says, I think having some exposure to long volatility in your
Mhm.
portfolio is good, 5%, right? And he says, like, it's not going to make you money most of the time. It's there more of like a circuit breaker. But the analogy he made was really good, where he said, breaks can actually help you win the race,
Yeah.
right? So, like, when you put something in a portfolio that slows it down 90% of the time, people are like, wait, why are we doing that? Right? Like,
Yep.
I want stuff that's going to have high return, right? And he's like,
Yep.
it's just like a race car. Like, you can't drive a race car successfully around a track in a race with no brakes. You'll crash, right?
Mhm.
So if you have something that you can use to slow down on the hairpin turns so you can then speed up coming out of the turns, you're actually going to win that race successfully, right? You need the brakes to win the race. And so, these are things that, again, I think they sound kind of counterintuitive at first to the average, novice investor, but they're just super important, tried and true ways
Yeah.
of successful portfolio management.
Yeah. And look, I agree with that. The problem for the average, so it's not a problem for Jim because he has the expertise and the tools to buy VIX options on a regular basis, monitor those, know what he's doing with it. For the average retail investor, there's not a good tool. Retail investors can buy VIX options. You have that capability, but things like the VIX ETF is a terrible proxy for trading volatility, and you have to buy it the day before volatility spikes. You have to sell it the day it spikes, so otherwise you just won't make money with it because the
There's
underlying
drift and
option will fall off.
decay and all that stuff. Yeah.
There's a bunch of stuff but there's not really a good tool to buy volatility. But your point is absolutely right, which is most of the time when you buy VIX options, they're going to expire worthless because the markets are going up. And so for most investors, they go, I just keep throwing money away every week. I just keep throwing money away in these VIX options. I'm not going to do that. But it's the same thing as maintaining a stop value on your portfolio. It's the same thing as doing a lot of other things, and people abandon those as well because it's like why would I buy insurance when the markets just go up every day? Because one day the market's not going to go up and you're going to be grateful you had that insurance. But we just train investors through the media, through everything else, is just buy an index and it goes up over time. Don't worry about the little volatility swings. And the little volatility swings are fine. Look, we just had a 5% correction, absolutely normal, shouldn't have even bothered you. But it had been so long since we had that 20% correction in April, everybody forgot about that correction. So 5% all of a sudden was like, oh my gosh, this is terrible. The markets are falling apart. And it was just a normal little 5% pullback. That's the price of admission to invest in markets. You shouldn't even if your market drawdown is 3 to 5%, that shouldn't even phase you. You should be just fine with that. You should welcome it. You should be buying into that. When you start breaking trends, breaking support, kind of like we did back in April, that's when it becomes much more important to pay attention to what's going on with your money. And you'll be glad that you had those hedges in your portfolio at that time
Exactly.
as well. But again, we train investors to do the worst things for their portfolios.
Right. And by we, you mean society, not RAA.
Yeah,
RAA.
yeah, yeah,
You're
yeah.
doing it
We
right.
we being we being the ubiquitous media, right?
Yeah.
CNBC, Bloomberg, whatever. They're
Yeah.
terrible. You should
All
turn
right.
those off and never listen to those if you want to manage your money better.
Totally agree. And I could keep you going down this path, but I want to talk about some of the things that broke this week. So the day we're talking, we got the uh, latest jobless claims data, and it was interesting. It was really quite mixed. The initial claims number went down. I think the previous week we're at 218,000. They're down to 191,000. That's the lowest reading since September of 2022.
Yep.
So for whatever reason, probably hiring for, things get holiday sales, that type of stuff.
Yep.
But so people are looking at it saying, oh, okay, it looks pretty good, right? But employers announced over 70,000 layoffs last month. These cuts were up 24% from the nearly 58,000 planned layoffs that were announced in November. So we've only had job cuts in November above 70,000 twice since 2008. That was in 2022 and in 2008 itself.
Mhm.
So not very fun years, right?
No.
So I kind of look at this and say, okay, we got a positive snapshot of a number that looked pretty good. We still have lots of questions about how good this BLS data is anyways, right?
Yep.
But if we look at the layoff numbers, we're starting to see more and more of a drumbeat that employers are starting to shed some of those jobs that they were hoarding.
Yeah, and
And I think
that's this chart I just put up for you as well.
up
This
here.
is the U.S. pace of U.S. layoffs, which are 153,074 job cuts in October, which tripled 2024. So, I have no evidence of this whatsoever, but I think there's something broken with the jobless claims data following the pandemic, and I just don't think those things ever normalized
Hmm.
back to where they should be. So I'm not, and again, I'm not saying it's government manipulation or anything like that. I think we've got a lot of problems with some of the economic data we get. Participation in surveys have dropped dramatically. Literally, the companies they survey just aren't responding, so they're starting to calculate a lot of stuff. Um, I can't put my finger on what's going on with the data. And again, I don't really have any supportive claims saying, oh, here's the problem. But it's just that the jobless claims data really doesn't jive with what we're seeing a lot of the real time kind of employment data from Paychecks, from the Small Business Federation, from the ADP reports. We should be seeing higher rates of jobless claims than we are right now. So again, I don't put a lot of I don't trade portfolios based on jobless claim data. That data has very little impact on the market itself, but it is, notable. It tells us a little bit about the economic strength. But again, I don't think that's giving us a good read like we're getting from other data.
All right. Well, we'll keep tracking this going forward. But as you say, Lance, um, the thing that just matters the most to where the markets are going to go are where earnings go. And companies that are laying off people, I mean, you can make one argument that, okay, they're in a cost-cutting mode and therefore profits should get better, earnings should get better. But obviously, you get layoffs beyond a certain scale. Consumers start really worrying for their jobs, either because they've lost their job or they saw their neighbor get fired.
Right.
And then that constrains consumer spending, which still is the main driver of our economy. And then, corporate profits go down because of those reduced spending.
Right. Exactly.
Yeah. Okay. All right. Well, we'll keep tracking that going on, but I want to put that in sort of a risk category for next year.
Mhm. Yep.
If we start seeing layoffs continue to build at this level, and if maybe the official jobs data starts coming into more alignment with what we're seeing elsewhere, that would be more negative. That
Right.
would be this would be something we should be looking at more closely. Okay, so another thing that's been going on that we really haven't talked about yet, Lance, has been what's been going on with Japanese bond yields,
Mhm.
which have basically exploded to their highest in forever. Um, so that should have killed the carry trade, has it?
No, not really. Well, and so first of all, let's separate out a couple of things. A lot of the data that's getting put out there by people's like, look at what's happening with the Japanese bond market. They're talking about the 30 and 40 year bonds, which those they don't even issue those anymore. Those are ancient relics of the bond market that exist there. But even the 10-year treasury, which has been rising, is 1.93%. I want you to hear that number. 1.93% on their 10-year treasury. That's the one that drives the carry trade. That's the one that drives the economy, everything else. The Japanese economy is in recession. They're in contraction right now, and their 10-year treasury rate's 1.93%. So yes, it has gone up because of concerns about everything else, but it is still well below the long-term trend line of, other yields around the world. So, part of the Japanese yen carry trade is basically I'm shorting JGBs, I'm going long US treasuries. As long as there's a spread, I make money. So we're at 4%, they're at 1.93. I'm picking up almost a 2% carry on that. So, that makes complete sense to carry that trade. Yeah, it's starting to impede that trade some, but not to the level yet that it's impacting the markets. If remember, we had a Japanese yen carry trade blow up
Right. A year or so ago.
last year, year before. I wrote an article about it on the website. And that was kind of a short-term anomaly in the markets. But this, yes, their yields are rising on the 10-year treasury for sure. Need to pay attention to that. But again, economic growth, demographics, the debt, the deficits, the same problem we have in the US is weighing on their economic growth. That's why their economy is back in contraction. We have exactly the same problem here in the US, the three Ds, debts, demographics, and deficits.
Yeah.
That's going to continue to erode economic growth. That's going to continue to drive yields lower in the US. And then as that occurs, we're going to wind up looking a lot more like Japan in the next 20 and 30 years.
Okay. Let me just ask though,
Mhm.
if the trajectory continues of what's going on in the Japanese bond market
Yep.
and it does start impeding the carry trade, how concerned do you start getting then?
Yeah, well, no, I mean, you're going to have another drawdown in the market. We were down 10%, during the last carry trade blow up. So, yeah, I mean, it's the Japanese yen carry trade is a leverage trade for the markets. So if something happens that they have to reverse that trade, they have to sell assets to cover that leverage. So it's going to impact the financial markets. And so, yes, it is definitely, and this is my point. Yes, we want to pay attention to it. We want to pay attention to what's happening. We are watching that, but
Yeah.
it's not leading to a level right now that's of major concern. And again, the kind of the stuff you want to be aware of is people running around screaming that the world's on fire because of the 40-year treasury. That has nothing to do with the markets.
Okay. So you're kind of like DEFCON 3 on this.
Yeah.
You're watching it, you're noted, a little worried, but we're not in crisis
Yeah.
territory yet.
That,
Yeah.
now that could change tomorrow, mind you,
Right.
right?
Well, it does. That's why I wanted to get this on the
Yeah.
board here because if
Yeah.
it gets worse, then we'll pick it up next week
Yeah,
or we'll pick it
exactly.
up whenever it
Yeah, I
does.
know. So, if something happens with the Japanese yen carry trade, it will literally happen overnight. And so, I mean, literally tomorrow, this is Thursday, tomorrow on Friday, the Japanese yen carry trade could blow up. So, and we could be DEFCON 5 tomorrow. That's how it's going to happen. It'll happen. This won't be something that you build into. Same way as it happened last time. You're literally going to wake up overnight and everybody's going to be deleveraging overnight. And
Okay.
by the time you get to the market's going to be down 3%.
Okay. And I don't think this would necessarily be a trigger, but it's something in this same part of the world. So, China has been trying to show signs of resilience. And there certainly have been, they've been stimulating, and there's definitely been some
Mhm.
data coming out of there that shows that making some progress. But we're all of a sudden starting to see some headlines again about the dire state of their real estate market.
Yeah.
And we just had another, I think folks remember the brand Evergrande, which was a big property manager and lender, I think, in China that basically defaulted on its loans and sort of sent shockwaves, not just through Chinese markets, but through world markets. There's another developer there, China Vanke, I think is how you pronounce it. It's one of the top three largest property developers. They just announced they're seeking to delay a 2 billion won bond repayment. And that has sent bond markets and in China tumbling, as well as share prices of their real estate companies again. So China is still, stuck in this vortex of this collapsing real estate bubble. Um, do you expect much from that, or do you think this will be isolated?
No, no, I don't think it'll be isolated. Let's back that up. Do I think that that's going to turn into the next subprime crisis? Probably not.
Probably not.
Um, is it going to have if that implodes in China, is it going to have an impact on financial markets? Absolutely. It's going to be good for the dollar. It'll be good for U.S. Treasury bonds because there'll be capital flight into the U.S. When that occurs in China. So, look, China's got huge problems. They have the same problem that Japan does, same problem that we have. China and Japan are far more advanced than the U.S. on debts, demographics, and deficits. So, they're going to wind up. Their economic growth rate, because of their demographic problem, is going to continue to erode. And again, it's always funny with China. China comes out with these economic numbers. It's like end of the quarter, 15 days later, here's our economic number. They never adjusted.
Yeah.
It's just, you don't even have the data in, but yeah, here's the number. Yeah. And it's always good. But you actually dig in, and we were talking about this 10 years ago, right? They were building these ghost cities. They were building these replications of New York City and everything else in China. Nobody was living there. It was like, this is just a function of time until all this blows up. But everybody was saying, oh, this is amazing for China. They're gonna bring in all these farmers from the countryside into the cities, and it's gonna make everybody prosperous. No, that was never going to happen, and it didn't happen. And all these cities that they built are still empty, or they've done other things with them. But now that's starting to all that debt run expenditures are now starting to play catch up, which was inevitable.
Yeah, yeah. Interesting that maybe this isn't surprising to folks, but the average age in China is older than the average age in the US now.
Yep.
And someone can probably fact check me on this, but I think that they might be the fastest aging country, meaning how fast their average age is increasing. And it's because they've got such a hole in their demographic stack
Yeah.
from that one child policy that they
Yep.
pursued for so many years.
Yeah, no, and look, we've got the same problem in the US. Our fertility rate is plummeting in the US. And this is why, we need to spend more time, get your wife on the show, talk about marriage, getting people married, getting people having babies, because again, demographics are destiny, and we have a huge fertility problem in the US. We have a huge demographic problem in the US. We've got this whole generation of baby boomers that are about to roll off. And when you have that kind of gap, and now that we've reduced immigration into the country, that's going to accelerate that demographic
Right.
problem, which is going to feed into economic growth and ultimately into earnings and the stock market and everything else. So,
Yeah, we talked about this. I want to see if we can get Chris Hamilton to come back on the
yeah,
program. He's the guy with all the demographic charts and to really
yeah,
talk about this. So you're absolutely right. Yeah, so this problem is not limited to the US. In fact, I think the entire West is basically stuck in this demographic trap as well. And it has all sorts of implications. And while it is a common problem where Americans, Lance, we care about our country, we got to figure out, I agree with you. We've really got to start to have a national discussion about, what are we going to do about this? And I think personal opinion, getting domestic births and that birth rate up, really important for us. As you and I have talked in the past, the whole Charlie Munger thing, it's all about incentives. I mean, I
yep,
think socially, we need to really take a hard look at the incentives that we're providing, which I think in so many cases are against family formation. And how hard it is for young families young people to be able to get married and to afford to start families and all that
yeah,
stuff. I'm all for creating whatever it is, tax breaks, economic incentives, whatever, to try to make sure that we encourage the most important thing to the future of our society is to actually make more of us,
yeah,
right? Now, to your
yeah,
point, immigration is going to play a key role in that. And what's kind of interesting, I know that immigration is a super flash point topic, lots of emotions around it. I know that a lot of people do not like either this administration's policies or how this administration is going about them. But I think we are starting to have some of the conversations that we have long needed. And we've talked about this in the past, Lance, like, A, what do we want our immigration policy to be? But also, like, who do we need, right? Like, what are the skills? What's the mindset? What's the skills? What's the cultural compatibility that we want to bring into the country? And it really may change
mhm,
the mixture very dramatically going forward in terms of the type of people coming into this
yeah,
country, either where they're coming from or what their skill level is.
yeah.
And
You know,
that's going to be
there,
really interesting.
Yeah, no, it is. Merit-based immigration is something that has been talked about for a long time, and we've kind of done everything but that. But again, if you're going to do immigration, you want to immigrate people that are going to contribute to your society. And, so, we want to immigrate. Look, our universities educate a tremendous amount of foreign individuals that come here, get great educations at Harvard and Yale and Stanford and everywhere else. Then they go back to their countries with those skill sets, which is fine. There's nothing wrong with that, by the way. But we need to keep that talent here.
Right.
We should want to import that talent.
I
And
think Trump joked of like we should staple a green card to every diploma, at
yeah,
least it goes to an engineer that's educated in our country, right?
well, but no, it's that's a good joke, but it's kind of true because the problem with immigration has always been, so I've immigrated several workers over my lifetime into the US, and the process of getting their green card, getting them here, getting them working, having to sponsor them
It's
and
hard,
provide
laborious, costly. Yeah.
it's very expensive. It takes 10 years to get them to where they want to be. We need to streamline that, right? If you want to come here and you've got your higher education, you're a doctor, a lawyer, whatever, but you've got a good, skill set that you're bringing over, electrician. If you're bringing a good skill set to where we can immediately employ you into the country, we need to fast track your citizenship into the country. If you're coming here with capital to start a business, we need to fast track your citizenship. We need to streamline some of these things for education and merit to where you can get your citizenship within 2 to 3 years. If you want to come here and serve in the military, you can fast track your citizenship. You spend 4 years in the military, great, you're a citizen. If you're going to
Yeah.
sacrifice yourself for the U.S., great, we love you. Here's your citizenship at the end of your first tour of duty. Maybe I'm being a little bit facetious, but you get the idea, which is we need to do some things to encourage the right type of immigration into the US so that we can prosper from that.
Right. And again, speaking as an American, and I know we've got a lot of viewers from other countries,
Yeah.
but forgive me for a moment. You know, uh, I think there's an opportunity here to jujitsu our biggest vulnerability into perhaps our greatest strength here, which is,
Mhm.
as Elon Musk said, America doesn't have a border with Mexico. It's got a border with the rest of the world, meaning,
Right.
painting with a broad brush, but everybody wants to come, right?
Yeah.
And
Well,
so
why
the
why
challenge with
wouldn't you? It's the greatest country for creating wealth. We prove that hands down, right? So yeah, I mean, look, I've traveled all over the world. I've lived all over the world, and I know you've traveled a lot, and it never ceases to amaze me. No matter where you go, people are like, yeah, I would love to be in the US. I want to go to New York. I want to go to Los Angeles. I want to go to, wherever. Nobody ever wants to come to Houston for some reason, but everybody wants to go to Florida, right? Um, but yeah, they want to come to the US because they know there's opportunity here to build wealth. And if you want the best opportunity for education, building wealth, there's no other place to be.
Right. So when we had, an open border policy,
Mhm.
we were overwhelmed because the rest of the world wanted to come. And I mean, you saw the same
Yeah.
news stuff I did, where it wasn't just people from Latin and South America, it was people from literally all over the world,
Yeah.
right?
Yeah.
So, what we should be able to do is, like I said, jujitsu that, right? And say, okay, once we've crafted what the new immigration policy is going to be and the incentives and who we want and all that stuff, and it's like, right, everybody,
Mhm.
limited spots per year, but we want X many a year.
Yeah.
Throw your hand in the ring, apply. Let's take the cream of the crop every year, right? So there's a real ability to do that. The question is are we going to? Who knows? I'm sure we've already enraged a number of different people on different ends of the spectrum just even talking about this, which is
Yeah.
sad because it's such an important topic. We
Well,
have to have an adult conversation about it.
right. No, and the thing is, like, look, if the conversation offends you, sincerely apologize because we're talking about the need to increase our demographics. We have a negative trend demographically, which is going to make the ability for future generations to build wealth and to obtain prosperity even harder. So we need to have this right type of immigration in the right amounts every year to stabilize and grow the economy. And if you don't agree with that, it's a function of go take a look at Japan. If we keep going the way we're going, we're going to be like Japan in the next 30 to 50 years.
Yep. 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 All right. Well, look, I'm sure we'll pick this back up again in the future.
Sure.
All right. So last topic before we start wrapping up. Um, this whole topic of the K-shaped economy, or as I like to say, the lowercase I-shaped economy. I mean, it really has gone mainstream.
Yep.
There's almost a day doesn't go by now where I don't read about it or hear about it in the media. And I was just reading this article. Uh, so Bank of America senior economist Aditya Bhav, I hope I'm pronouncing your name right, emphasized that the haves versus have-not split is real. So, you got Bank of America basically saying, yeah, the K-shaped economy thing is a real thing, but it's not necessarily destabilizing in the real term, because higher income households spend significantly more on services, which dominate the US job market. One reason to be less pessimistic, she says, is the following. Who spends more on services, higher or lower income folks? It's actually the higher income folks. Sorry, it's a he, not a she. So if you take $1 of spending and you tell me that it was actually spent by a higher income household, I'll say that's more likely to have been spent on services. It matters because 5 out of 6 jobs in the US are in the services space.
Mhm.
So more spending on discretionary services could actually be more supportive for the labor market and increase the chances that the labor market will stabilize. So
Mhm.
may possibly be correct on that, but it's hard for me not to read that without hearing them say essentially, everything's going to be fine just as long as we keep the rich people happy and spending, right?
Well, the top 20% of income earners comprise about 50% of spending.
I
So
almost think I know the data you're talking about. I almost want to say it was the top 10%, but even if
maybe,
it's just the top 20, it's
yeah,
yeah. So it's true. It's true. I'm not necessarily
yeah.
saying the stats aren't true. What I'm saying is it is really hard to look at that situation socially as anything other than an aristocracy, where they're basically like, yeah, it's the rich people's world, and the rest of us just have to make it go round. And if we want to be happy, we got to make sure that we're working some sort of service job that's, you know, making some rich person feel pampered, right? And look, I understand the 80-20
Well,
rule. There's always going to be
yeah,
a
yeah.
higher echelon of society, but
But spin it
America,
around. But wait, but spin this around the other way, right? I mean, it's, I'm not disagreeing with you, right? So I
yeah.
just interviewed Peter Atwater on the Real Investment Show, and he was the guy that actually kind of founded the K-shaped
Yeah,
economy term.
he didn't come up with it, but he saw the guy that did,
Yeah,
and he popularized it.
yeah,
Yeah,
yeah. He so
giving
popularized it. That was the
attribution,
word I was looking for. Yeah,
giving attribution to the guy who did do it. So
yeah,
Peter was
exactly.
fully
Yeah,
above board.
but
Yeah.
yeah, the popularized was the term I was looking for. So thank you for that. But again, we just had a big conversation about this whole K-shaped economy. And so here's the thing to think about. Your point is perfect. And this is if I could give a message to anybody out there, this is the message you should hear. So what Adam just said is that the 20% of the population, they need the bottom 80% to provide the services to those top 20%, right? That's the aristocracy. It's really capitalism because here's the opportunity. If you're in the bottom 80% that's providing the services to the top 20%, build a business out of the 20%, out of the services that you're providing. Build a business out of that. Become the provider of the service, and you will move yourself into the top 20%. That's how the people in the top 20% got there in the first place. They are the providers of labor. In other words, you provide labor, they provide the capital. And so because of that, that money works its way upstream. And so as individuals, and this is what I did, right? This is what Adam did. Adam wasn't in the top 20% of income earners 10 years ago. He's in the top 10% of income earners now because he built a business. He found a niche that provided a service that all of you right now watching this video are willing to subscribe to his channel, subscribe to his Substack, pay for his conference. That's what makes him money. He founded a service that you now participate in. I provide a service to my clients that I benefit from that. I wasn't in the top 10% of income earners 15, 20 years ago, right? I had to grow businesses to get there, but I'm nobody special. I went to college, I got a degree, I found a niche, and I worked my ass off to build a business. And I've had several iterations of that over time. Challenges, failures, everything else. But you can do this. You can take whatever service you're providing. If you're an electrician, I've got electricians downstairs working in my house. That's why I'm bringing this up. But if you're an electrician and you're working for somebody, you're working for the owner of an electrical company, right? You're providing the labor. What's stopping you from going out, getting your master's license, and starting your own electric company,
Yeah,
right?
let me interject here because Lance, I
Yep.
want to have this discussion with you
Yep.
when we have a little bit more time and give it full justice. So I'm in agreement with you, and
Yeah.
I totally want to have the team. This is what you as the individual can do in a capitalist
So, but
world.
here's my point
Yeah,
back to this is that this is capitalism at work. The reason that you have 20-30% of the population driving the majority of spending is because the bottom part of the economy is the labor providers. And you're always going to have this split, this, and yes, we've done some things in the most recent decade in particular that have made that gap much worse. Zero interest rates, bailouts, all this type of stuff. Look, we did the bottom 80% no favors at all. We decimated the bottom 80% by giving them no income loans, adjustable rate mortgages, so they could all go out and buy houses they couldn't afford. And we absolutely devastated that bottom 80% of the
right. And those
population,
checks to
putting,
households were actually the
yes,
long-term cost of that, I think, totally detrimental
absolutely.
to them. Yeah.
So we've done a lot of things in the name of saving the economy and the markets, and everybody cheered, hey, hey, great, we're going to send money to households. That made things worse.
Right. So
And
let me, you're going where I want to go. So let
yeah,
me just make a few points and let you
okay, go
run
ahead.
with it here. So, like I said, I get the Pareto principle. There's always going to be a
Yep.
20% that does better than the 80%. It is the size of that gap and the
Yep.
momentum of the gap that concerns me. You probably, I imagine, spent some time in Latin America and South America.
Oh yeah.
You look at those economies, those are aristocracies. You've
Mhm.
got, some very rich ruling families basically that own everything. And then the 99% of that country just basically works for those people, right?
Yeah.
It is what I consider to be a dramatically out of balance society from a wealth sharing standpoint. And I'm not arguing for anything socialistic, as you know, Lance. I'm a
Yeah, no.
massive capitalist.
Yeah, yeah.
So one that's the thing I'm putting my finger on with this Bank of America quote, where it's almost like we're cheering the Latin Americaization of our society. Now, here's the other point, and then I'll let you respond.
Okay.
Is okay. I don't think that that's a very great way to evolve, or I would say devolve your economy, which is kind of like how I say with Manhattan, where when I used to live there, they'd say you got to keep the bankers happy because they fund everything, and I was always like, well, who the hell made these guys the princes of Manhattan, right? So to say, look, we got to keep the super rich elites happy because then they're gonna that's gonna trickle down and pay the rest of us. I don't personally don't think it's a great way to do it. But now let's flip that, Lance.
Mhm.
So now we've got AI in the age of robotics. So these rich people who own the capital, have all the capital, own the companies. What
Mhm.
happens is they start putting more and more of that capital towards replacing their dependence on human labor. Now you've
Yeah.
got the worst of both worlds. You've got
Yeah.
the Latin America environment, and they just don't even need the damn 99% to do
Oh,
their
that's
stuff because they've got automation and robots that can do it.
yeah. The whole AI thing, that's a different conversation.
But it's
I
tied to
have
this.
no, absolutely they are connected. I have huge concerns for my kids over AI, and what their future looks like in terms of what roles they're going to have. And this is why I am, pushing my kids very hard right now to make very good choices in their education process. Or, my daughter is an esthetician, so she's a service provider. And but that's not something that's going to be replaced by AI anytime soon. Now, eventually, if we can get if Elon Musk can build a robot and we can stick AI in it, then yeah, maybe we have electricians that are robots that are doing some of
That's
the
what Optimus is. That's Optimus's vision in 5 to 10 years.
yeah, and so maybe a lot of jobs come under threat because of AI. And then there's always the argument. It's like, well, somebody's going to have to repair the robots. No, robots can repair robots. So,
Yep.
that's the other problem. So, no, I have huge concerns over that because the solutions that I hear from people, even Elon Musk, is that, oh, well, we'll just have to give money to households and
Yep.
we'll just have to, give them some UBI and they can go
It's a
do whatever.
non-solution. Yep. You create
And
a dependence class that never gets beyond subsistence living.
exactly. And you talk about Argentina, you talk about, some of these countries that have very, very large, very poor population structures. Unfortunately, that's kind of what I'm that's the dark future I'm worried about.
Right. And
Outside
sorry,
of that,
sorry to interject, but
yeah,
if Elon's successful in building millions of these things,
yeah.
maybe our immigration policy super changes because we don't necessarily need a lot of this labor. That's just
Uh,
another interesting wrinkle. So,
yeah, I mean, that's a side of the things that I really do worry about. But back to our conversation. No, you're
mhm.
right, and I absolutely agree with everything you're saying. We have got to stop. We have to stop as a government. Stop providing all these supports to households because it doesn't make things better. Let me give you an example. I give you child tax credits because childcare is expensive and and both parents need to work. Look, we raised four kids, both of us were working. We had to pay for childcare. It's expensive as crap.
Yep.
It just ate into everything we were making trying to pay for childcare for four kids while we were still trying to work. We would look at each other like, why the hell are we working? Because we're giving everything to childcare.
So just to connect one dot here,
Yeah.
Mike Green came out with a piece this past week. I don't know if you saw it, but it was revisiting the poverty line
Yep.
because he basically said
Oh,
if you're making like
I
four,
read that article and there's so many flaws in that.
oh really? I thought it was a great
Yeah.
piece, but basically what he talked about was kind of what you're talking on here, which is there's kind of gap where if you make below a certain amount, there's enough subsidies that you're going
Mhm.
to live and feed your kids. The more you work, there's like between 50 grand and a little over 100 grand. Increasingly, that just goes to daycare because now you're second, like you get no advancement basically between 50 grand and 120 grand
And
each.
and the reason is because of all the subsidies.
Right.
And this is exactly my point about
That's why I
childcare.
wanted to bring it up here. Yeah, it
Right,
ties to.
right. So, the whole point is that it's like, okay, great, we're going to give you a subsidy for childcare. Well, what do the childcare providers do? They immediately raise their rates to adjust for the subsidy. So now that subsidy is not subsidizing anything. And of course, as inflation goes, they're still raising their prices, but you're not getting additional subsidies or tax credits or anything else. It all sounds good in nature, but we have to stop that. If you want to solve some of these problems, you have to allow the free markets to work as free markets. Cut out all the subsidies, cut out all the tax credits, because then what happens is that people go, hey, I would love to pay you for some childcare, but I just can't afford you. Those prices have to come down. The childcare providers will have to lower their prices in order to stay in business. And so things will normalize back to better levels. Again, you're going to go through a very painful period, right? We're going to have a recession, we're going to have a lot of other stuff. But again, just like the forest fires, we have to go through this if we want to solve these problems. If we want to bring housing prices back in line, 20% down payments, 720 credit scores, that's the only way you can buy a house. All of a sudden, you zap all the demand in the market because nobody can afford that. Housing prices have to come down.
Yeah.
It's just a function of supply and demand.
Man.
And so a lot of this stuff that we have created in this K-shaped economy is a function of that we're always wanting the government to give us something. We always want the government to give us a handout in some shape, form, or fashion. And the rest of the economy immediately adjusts for that. And that's why you have inflation.
Yeah, and it distorts and deforms the system, and it's not too different from your
Mhm.
criticisms of California not doing its controlled burns, right?
Nope.
You just create an artificial system that you know um, uh, at the end of the day creates more problems than it's solving, right? Where the free market is draconian and Darwinian, but it actually keeps things
Yeah.
sustainable, right?
Yeah.
Okay, I know you got to go real soon, Lance, so we'll
Yeah.
wrap things up. First off, trades. Did you guys make any material trades over the past week?
So last week we told you that we kind of rebalanced our portfolios. We added to Meta, we added to some other kind of stocks in our portfolio, trimmed back Google. We haven't done any trades this week. We were positioning the market for this kind of end of the year rally last week, and so pretty much probably I don't think we're going to do a lot of trading between now and the end of the year. I think we're in a pretty good position. Um, Today, Meta's up 4.5%
I
today.
was going to
Nvidia's
say
doing
congrats on
well.
the Meta pop.
Yeah.
Yeah.
So, but those were kind of, and I was on Fox Business News yesterday. I said, hey, a great short-term trade for the end of the year will be Oklo. And then it was funny because she goes, well, why you say it's only a short-term trade? I said, because they have no revenue
Right.
at all, period, nothing. No telling when, and there's no horizon for getting revenue for this company. But, that stock's up like 13% today. So we're starting to see, and the whole reason for that
Was
conversation
because
was
you mentioned them on Fox Business. That's why.
exactly, exactly. Everybody's buying it today. No, but no, this is that beginning of the end of the year kind of positioning. People want to be in these stocks for the end of the year reporting. So I think you're going to see a lot of this. We talked about buying Eli Lilly and AbbVie a couple of months ago because they were very out of favor. We've taken profits out of those recently. Those are starting to come under a little bit of pressure. So, we're starting to see a little bit of this rotation trade back in the markets for this end of the year build out.
Okay. All right. Seems like you position yourself well, and
Well, so far, we'll see if it
we'll see if you
helps.
get the ride you were hoping for. Yeah.
Yeah, we'll see what
I,
happens.
I do think it's a little bit ironic that the pop from Meta was because Mark Zuckerberg said, "Hey, you know what? Meta, our whole metaverse thing isn't panning out the way that we thought, so we're going to dramatically cut back our staffing there." And so Meta, which was Facebook before it renamed itself Meta because of its whole metaverse operations, is now kind of beginning to give up, or at least dramatically
The
underinvested now.
meta thing was never going to be a thing.
You
The
know,
whole
it's going
virtual
to though.
reality and
It's going to. Sadly, I believe in 20 years it's going to be Ready Player One. It might not be.
you're probably right.
Yeah,
You're absolutely probably right.
yeah, yeah. I think they were
We
just
should
hoping.
have a we should have a show where we just stream for 2 hours. We just stream Ready Player One.
Actually, it'd be kind of fun to find like a virtual metaverse to record one of these in, and we can have a virtual Lance
Yeah.
maybe up with a virtual Adam. That would be kind of fun. All right. I know you got to go. Do you have 2 minutes?
Yeah, yeah. Go ahead.
Okay. Okay, I had a different rant. We'll save it for a different day. I think I've told you this privately, Lance. I have recently signed up for a concierge medical
Hmm.
program,
Yep.
and look to a certain extent. This is, I've been fortunate enough to get to the life stage where I can spend a little bit of extra money on healthcare. But as you and I have talked about many, many times, money is not the end. It's a means to an end. The things that
Hmm.
really matter in life, relationships, purpose, and health, those are the things you really want to focus on investing in life. And I've definitely found some great benefits from this concierge program. And it's also not that expensive. I mean, it's really not. It's probably for what I pay for 1 month in healthcare premium. That's what the cost of this thing has been to me. Now, there are some additional things that I have to buy, and that's one of the things I want to talk about. This concierge doctor has signed me up for kind of a battery of additional tests that my normal healthcare provider
Hmm.
wouldn't naturally prescribe for me. And a lot of this stuff is just diagnostic stuff, just to make sure I'm doing okay. So he
Hmm.
went through a list of all the things that are likely to kill a male in his mid 50s and said, let's start ticking as many of those off the list as we can. And so I went and just got like a CAT scan of my, or CT scan of uh, my coronary arteries. And I'm very happy to say came back zero plaque on them, right? But so
Right.
huge relief, very important bit of information to have, right? Cost me $120,
No.
right? Similarly, I haven't gotten the results yet back, but he had me do a cancer screening test, which it's again not something that your normal healthcare will cover, but it screens for like 20, almost 30 different type of cancers, and it's all hopefully early detection, right? So it's say, okay, all right, if it looks like you're starting to see a marker for X, well, let's get it attended to maybe if it is cancer, when you're at stage one versus when you're later on down the road. Hundreds of dollars, right? Not that expensive when you consider that it could be the thing that saves a life,
Yeah.
right? So I could talk more about this in the future, Lance. I think you perhaps
I
maybe
have
have
one too.
yours that
Yeah.
you do as well.
I have a concierge doctor and I will never go back.
Okay.
No.
So
We,
again,
we, 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 if you want to spend some more time next week or two, we can certainly talk about it more
I
because
was just going to say that when
I
you have
love
more
my
time,
life.
maybe let's dig in that. If folks want us to, let us know in the comment section below. But I bring this up just to say there are some things here that are on a relative basis very inexpensive, but have a high degree of value if they help you catch something early. And so if anybody's listening who's been toying with this, so far my early experiences have been extremely positive. Sounds like yours have been as
Yeah.
well.
Absolutely. Yeah.
Okay. Well, look, folks, in wrapping up, if you think one of the best ways to secure your long-term health and happiness is to continue to watch Lance Roberts on this channel week after week, please let us know that by hitting the like button, then clicking on the subscribe button below, as well as that little bell icon right next to it. Lance and I talked an awful lot about where 2026 may go. If you would like to get some professional help in terms of positioning your portfolio for next year, whether it's for the potential challenges or potential opportunities, then if you already don't have a great financial advisor advising you, consider talking to one of the ones that Thoughtful Money endorses, perhaps even Lance and his team there at Real Investment Advice. To do that, just fill out the very short form at thoughtfulmoney.com, and the firm will be in touch with you right away. Lance, my friend, it's been absolutely great. Good luck tomorrow with your wife and her treatment, but
Okay.
I'll give you the last word as usual.
That's it. But that's it. Have a great week, and we'll see you back here next week.
All right, buddy, thanks so much.
Thanks.
Everybody else, thanks so much for watching.